estate's hella expensive right now, so it's no surprise investors are jumping all over these cheap properties in the Midwest, in the South, in these secondary markets, looking for cash flow, looking for affordable deals. But there's a lot of things wrong with this investment strategy if you don't know what you're doing. And we know what we're doing, so we're going to give you 5 rules that we stick to religiously today to ensure that our affordable housing investments in inexpensive towns are actually making money and aren't just fool's gold. So follow along. And before we jump right into it, let me give you some free stuff first. Let's plug you since we haven't done one of these classes in a while. Let's go ahead and hook you up with the rental property calculator. I'll make it 20 free copies. You got to go to our link in bio to redeem the coupon code I'm about to give you. They go really fast. The wolves jump on. It's active as you're watching it now. So take this code, jump over to our website. If a coupon code slot is still there, that means not all 20 have been redeemed yet. The code is cheap deals. All one word, all lowercase. The rental property calculator is what our sales reps use internally to power through deal analysis, like while they're still on the phone. Super efficient. It's going to give you accurate numbers so you don't buy the wrong deal. And while you're at it, go check out the virtual investors guide on our website too after this video is done, or just click the link up above my head, because this thing is our internal blueprint. It's literally what we use to train our acquisitions reps to go out and get off-market, discounted, cash flowing affordable properties in these Midwestern and Southern markets 100% remotely without leaving your desk. And it's pretty freaking cheap compared to all the other courses out there. It's $600, guys. It's a low price for the amount of information that you're getting. But now that we're done with all the plug-in, let's jump right into it. So the problem with cheap properties, there's really only 2 major problems to these affordable investments. It's turnover and it's repairs. And the issue arises from the value of the properties being low. When the value is low, you cannot afford to not make money on a regular basis or lose your tenant every 6 months or 1 year. And you can't afford to put too much money into this thing unless you expected to and bought the property for a big discount. They're just not worth a lot, so you don't have a lot of margin of error. You got to bake that in. So to avoid the likelihood of turnover and repairs being really high, I'm going to give you 5 rules that you really need to stick to. So follow along. We're going to power through this pretty quickly. Rule number 1, smaller properties, bigger units. Now you got all the big heads like the Grant Cardones out there saying you got to go to at least 16 units to start, or invest in a 100-unit syndication, or buy an 8-plex at least. Not in these cheap neighborhoods. The more units, the more turnover, the tougher the tenant you're going to deal with, the harder it is to find a good management company, and the lower value per unit. The higher you scale up, the lower value per unit. In fact, a lot of property management companies in these inexpensive areas, they won't even take 4-plexes. So we like to play in 2s and even single family homes in the real affordable parts of these cheaper cities, the Milwaukees, the Clevelands. If you're looking at the suburbs of Detroit, a lot of these markets offer some very inexpensive multifamily. Don't fall for the trap of going for that 4-plex that's only worth 160, 180 grand at market value all cleaned up. It's just not worth it. The house, the duplex, more likely to foster a family, and that's where the second part of this rule, bigger units, comes into play. You got a nice big duplex, 1,200 square feet per unit, maybe 3 bedrooms each. That's very similar to a single family home as far as what it can house. And a single family home, 3 bedrooms, 4 bedrooms, if you get into 4 or 5 bedrooms, you might even be able to fit 2 families, 2 working class families in a single house under one roof, making it very appealing and very affordable for them. And there's room for everybody also. So more bedrooms, more square footage, fewer units per property or under one roof. That's usually going to translate to more stability. And it's market by market, so talk to property managers about how they feel about each of these assets. But rule of thumb, 4-plexes in C- neighborhoods, usually not it. Rule number 2, fix them up proper. Now you gotta actually buy them at the right price and make sure you have the budget baked in. But if you're in a position where you're not spending money on your property, you're leaving things somewhat in disrepair or in low grade condition, in an area where the tenant pool can be problematic, then you're gonna be uncompetitive in this tenant pool, meaning you're gonna get the bottom of the barrel in an already possibly difficult tenant pool, one that may not pay, may not stay. You need to be able to get the best tenants in that tenant pool. So fix your properties up proper. Don't just leave them low grade. Don't overdo them, but get them up to the market standard, because you will suffer from lower performance if you don't do that, if you don't budget for that, if you can't afford to do that. So that's rule number 2. Rule number 3, you need to have minimums for value and rents and not go below them. What does that mean? I won't buy a duplex where fully fixed up, stabilized at market rents, it's not worth at least 130 grand, 125 grand. Why? Because if a property in like some neighborhoods in Cleveland, even if the manager says they could do it, even if the cash flow works, if the maximum value of that property all cleaned up is $80,000, $90,000, you're still spending 10 on a roof. You're still spending $6 a square foot to install LVP. And you do that enough times and your total money into the property begins to exceed the maximum market value of it. And then you're relying on cash flow to pay for these expensive improvements, not the equity of the property itself. You go too cheap, you could easily be all in for more than what it's worth, right? And when rents come into play, if you're renting a property out, even if the cash flow works on paper percentage-wise, if you're renting units out for 2-bedroom units for only $700 a month, all cleaned up, you're never gonna collect enough monthly maintenance and vacancy reserves to have a big enough buffer pile to pay for the cost of these incidental expenses as they happen. So have a minimum for rents and a minimum for values. My minimum for values is probably 60, 65K a unit these days on the lower side. If you're in a multifamily building, on a 3-bedroom house, probably something that's worth not a penny less than 90 cleaned up, but probably 100 all cleaned up. And then for rents, 2-bedroom apartment, it's got to rent for $850. It's got to be able to rent for $850. A 3-bedroom house has got to be able to rent for $1,100, and that's my minimum for this thing to make sense. Rule number 4, you want to be. This is not a necessary thing, but if you want to make sure you get some predictability out of it, you want to look at these cheap towns, and you want to go in the slightly better parts of the cheap towns, right? If you don't want to deal with the risk of these things happening, then go to a market, a city that has 12 cap properties available in good condition at market value, and then go to the part of town where you get a 9 cap or a 10 cap. And I know some of us are so returns oriented that we think cap rates are all there is to a deal. I promise you that's not it. I'm always trying to convince our investors to not just look at the cap rate. Yeah, there's good deals out there that are 11 and 12 caps for sure, but if you want to trade some return for higher predictability, which means if the likelihood of you getting the 9% cap rate is actually higher, I would recommend getting into parts of town that are a little more expensive in cheaper cities overall. Managers are going to like you. You're going to have an easier time finding a manager that you like, right? They don't have to do a perfect job for your property to succeed, and that's a big part of being an out-of-state investor. Your property manager not having to be perfect, because they're not going to be most of the time. And then number 5, since we're on the topic, you want to be in a part of town where you can interview and give the thumbs up to multiple managers, not just multiple managers that are actually leasing units in that town. You want to have more than one manager that you would give a shot, that you think would succeed with your property. And I've given you like free classes, and even like there's a purchasable tool, like an interview guide in our ACE store for like $40 that tells you how to vet property managers. But you want to vet your managers, and you want to know you got a backup, because in the tougher parts of town, if a management company suddenly changes, their costs go up, they lose a vendor, they lose a key employee, they have a strategy shift, the owner gets sick, they decide to downsize, whatever it is, you're at risk of losing your only supplier if you don't have a key backup. And all of a sudden, your property becomes unstable. You can't stabilize it yourself if you don't live there. You need someone to do it for you. If you can't find that person, you might have to fire sale it, right? So only go where there's backups. And those are the 5 rules, guys. It's a lot of little things that you need to do to properly evaluate these things too along the way. And this is stuff I've taught you in other videos, I teach you in the course, all that good stuff, right? But if you stick to these 5, number 1, smaller is better, so less units, but bigger units. Number 2, fix them up proper. Number 3, have your minimum rents and values and don't go below them. Number 4, get in the better parts of the cheaper cities, or slightly better parts than the worst parts of cheaper cities. And number 5, always have backup managers. Then you're probably gonna be okay getting into this business. And remember, the newer you are, the less experienced you are, the more strongly you want to stick to these rules. So get out there. I hope you took notes, follow the rules. Happy hunting.